Mel, you're on mute.
Oh, sorry. Hi, good morning, everyone. Thanks for joining the weekly research morning call. Today we have quite a few stock hunter updates. We have Netflix, KDC, FCT, and OUEREIT. Yeah, followed by the Euro technical pulse and Singapore weekly. Yeah, so this is our Euro disclaimer. Yeah, so without further ado, I'll hand over to Helena for Netflix.
Thank you, Mel. So Netflix released their earnings last week. Another round of very solid result. So the fourth quarter revenue and PEMI were both in line with our estimate. Their FY24 revenue and PEMI were at 101% of our FY24 forecast. So their revenue grew 16% year on year. This is driven by a very strong new membership addition. So they increased 19 million new membership this quarter, which is plus 15% year on year. This is their largest quarterly increase in the company's history. The second largest would be the fourth quarter last year, which increased by 13 million, followed by 5 million in the last quarter. So moving on to the positives. The first one would be their revenue and margin both above guidance. Their revenue, like I mentioned, was pushed due to a healthy membership growth. This is brought by their thriving ad-supported business, as well as a very popular lineup of the content, including the Squid Game, Carry On, and the live streaming of Jack Paul versus Mike Tyson fight. Their operating margin also surpassed expectation by 60 BPS. This is supported by their cost discipline and strategic investment in growth priorities, including ad, live, and gaming capacities. The second positive point would be a very strong growth in the ad department. So the ad department is basically something relatively new that they roll out. So they're giving consumers a cheaper subscription option, and in return, you just need to watch the advertisement. And this continued to scale very well. Its membership grew 30% quarter on quarter, which they also grew similar amount in the last quarter as well. And it contributed to more than 55% of all the new signups. So management kind of highlight that the engagement among these ad members remains very robust. So their viewing hours is actually very compatible to those that are on non-ad plans. So moving forward, Netflix will actually focus more on shifting towards enhancing CPMs for advertisers so as to drive monetization further. Netflix anticipate their ad revenue to double year on year in FY25. The last point would be further margin expansion. So Netflix noted that they currently only capture around 6% of its estimated revenue potential. So they will definitely focus more on long-term monetization by gradually increasing the price as it enhance the variety and quality of its content. So Netflix projects a 10 BPS year-on-year improvement in their operating margin for the next quarter and has increased their FY25 operating margin guidance by 1% to 29%. In terms of guidance, they have guided $10.4 billion in revenue for the next quarter. This is supported by a combination of increasing membership rates and prices. And like I mentioned before, they expect operating margin to increase 10 BPS. We think Netflix continue to showcase its dominance in the streaming market, supported by their rising membership, their higher pricing power, and expanding margins. And also we think its explore into the ad business has been highly successful. As the business scale, it can definitely help Netflix to diversify its revenue stream, kind of reduce its reliance on subscription growth alone. So the company continues to outperform its closest rivalry, which is Disney. It has nearly doubled the ARM and subscriber base. But however, we're seeing with the stock currently trading at FY25 PE ratio of 37x, it is a little bit well above the industry average of 17x. So we're seeing the upside appears to be quite limited at current valuation levels. In terms of valuation, we raised our FY25 revenue by 4% due to robust membership addition and thriving ad business. We also raised their PEMI by 6% to account for the higher margins due to increasing operating leverage and cost discipline, and also continued gradual price increase. So we raised our DCF target price to $870, but we actually downgrade from neutral to reduce to account for the recent share price trends. So that's all from me. Now I'll pass my time to Igben.
Thanks, Helena. Now I'll be presenting Phillip on the ground on SK Hynix. SK Hynix recently released their fourth quarter results. So for those who don't know, SK Hynix is in a memory chip. It's a memory chip producer. So they produce DRAM, NAND, and high bandwidth memory chips. You can think of them a bit like a competitor to Micron. So for their revenue, it is up 75% year on year, and they also turn profits around from negative profits last year, fourth quarter, to positive profits this year. And as for the DRAM segment, as you can see in the chart on the right, the DRAM segment has been driving revenue growth significantly because of the shipment of high bandwidth memory products, HBM3E products. So um, for those who don't know, HBM chips are used in HBM chips are able to store and transmit memory very quickly. So they are used in AI applications. So in a typical GPU server, HBM chip will account for around 30% of its value in a typical GPU server. So because of the strong demand in AI applications, SK hynix has benefited from this trend by shipping a lot more HBM products to its customers. As for the NAND segment, sale of enterprise SSDs increased for solid state drives, but then it is offset by decreased demand from inventory adjustments by PC and mobile customers. So as for our outlook, we do see continued strong demand from ASIC customers. So ASIC stands for Application-Specific Integrated Circuits. So these are customers which require custom AI chips. So for example, like Broadcom. So we do see that HBM segment will continue to experience a very strong growth. However, we do see demand for AI and PC segment to be slightly impacted because SK hynix has guided that because of these inventory adjustments from its PC and mobile customers, the first half uh, results this year for the memory and NAND segments for for PC and smartphones will be affected. So companies like Intel, which is very big in the PC space, as well as companies like Qualcomm and Samsung within the mobile chip space may also be impacted in the first half of this year. However, we do see demand to gradually improve towards the second half because it's a cyclical kind of thing for the inventory adjustments. Yep. So that's all from my end. I'll hand over the time to Darren.
Yeah, thanks, Sigman. Also, Darren is in a physical result briefing, yeah, so I'll cover him. And this is an update for FCT. So all the other malls maintained occupancy level at above 99%. So management gathered that the rental reversion remain very strong and should be at similar level to FY24 level of around 7.7% for rental reversion. And we believe with the high occupancy rate, FCT is also well positioned to negotiate for higher rents. And we expect retail rental spending and tenant sales to be continued supported by the government incentives, such as the CDC voucher and also progressive wage model for the low-income wage workers. And FCT has no refinancing obligation in FY25. So we expect all-in cost of debt for FY25 to remain at around 4%. And for outlook, the Hong Kong Mall AEI has secured a pre-commitment level of around 50% before the work commencement. And the FCT is targeting at around 7% ROI on the project. And the mall will remain operational during the AEI period. And our occupancy rate is expected to stay at above 80% throughout the fitting out period. And management plans to offset the income loss during the downtime by collecting more the management fee in units. And apart from that, the inorganic growth opportunity includes acquisition of the sponsor stake in North Point Center South Wing, and also the remaining 50% stake in Next. And also with the limited incoming supply overhang for the next 3 years, which only represents 1% of the current stock, the potential for strong rental reversion remains high. Yeah, so we maintain a buy recommendation with target price of 2.44 for FCT. And moving on to KDC. Yeah, so the results are in line with our expectation, and KDC remain high occupancy rate of 97.2%, with strong portfolio rental reversion over 30% for its fourth quarter 2024, and FY24 whole year wise is around 39% for its rental reversion, and there's another 15% of the list are due to renew in FY25. So most of them located in Singapore is co-location list. So we expect the reversion to remain at similar level. So should be around like 30-ish level, supported by Singapore's very resilient demand and also constrained supply. Yeah, so which provide the landlord significant bargaining power for rents. And for the capital management front, average cost of debt improved to around 3.1%, and last quarter was around 3.3%. So we expect cost of debt to remain at a similar level in FY25. And KDC also saw growth in valuations. Excluding the acquisition and divestment, the growth was around 3.4% year-on-year. And the only negative for KDC is the rents continue to be owned by the master lessee in Guangdong DC. And to date, it already owns over 30 million of the overdue rent. And for outlook, the data center sector is experiencing substantial growth globally, fueled by digitalization, AI adoption, and cloud computing, and also expansion of the 5G network. So the new supply of data center in Johor is unlikely to significant impact Singapore, as they target a different market segment. So Singapore's data center has a focus on the high value AI computing workload, and rather than the training, so which is more prevalent in Johor. Yeah, so that's all for KDC. So we remain a neutral call with target price of $2.25. I'm moving on to Mapletree Logistics Trust. This is a Phillip on the ground, and we don't cover MLT. Yeah, so MLT faces very steep negative rental reversion of around 10.2% in China during third quarter FY25, with first tier cities seeing a smaller decline of around 3.1%. Second tier is more severe, is dropping by around 10.5% year-on-year. And nationwide vacancy rate is also elevating at around 20% level. And because like China is representing more than 50% of the rents, which due to expire in the upcoming quarter, so in fourth quarter 25. So we do expect this will drag down the overall revenue performance for MLT. And management anticipate the rental reversion to stay at the low teens negative range for the next 1 to 2 quarters before it easing to the high single-digit negatives. For the remaining year. And Hong Kong faces like challenges from the weak consumer spending, and also pretty sluggish property market. And rents have come under pressure due to the negative net absorption. And despite this, MLT's occupancy rate in Hong Kong remain pretty strong at 97%, supported by the limited available supply of the grade A logistics space. And for capital management, management guided that cost of debt will be slightly higher to around 2.8% at the end of FY25 and around 3% at FY26. And for outlook, we do believe like China will be impact heavily depending on Trump and his policy. And rental reversion for Singapore will be moderated down to around mid-single-digit level, especially with the new upcoming supply entering into the market. And dividend yield for MLT is trading at around 6.3%. And moving on to the FY24 result for OUEREIT. So the result is within our expectation, but DPU declined slightly by 1.4%. Outperforming our forecast by 12%. This is because of the reduced capital retention and also additional capital top-up of around 5 million from the divestment of the OUE Bayfront. And for positives, strong rental reversion extended into FY25. So we saw 19.8% rental reversion for Mandarin Gallery and 10.7% for Singapore office segment. And office occupancy rate dipped marginally due to the income supply influx in CBD area. But we do expect the vacancy pressure will be eased in 2025 due to construction delay of the Shaw Tower. And also the IOI building is more than 80% committed. And Keppel South Tower will be the only upcoming supply in 2025. So it's for the CBD area. So this is supporting our forecast of around mid-single-digit rental reversion for the office segment in 2025. And for the retail side, OUE is rebalancing its tenant mix to align with the consumption downgrade trend, especially from the Chinese tourism. So they are shifting from the luxury end to more of the affordable fashion category. And tenant sales in Singapore has been pretty muted. Occupancy costs for Mandarin Gallery remain stable at high teens, and we do expect rental reversion to stabilize in 2025. As majority of the low rent signed during the COVID has already been flushing out. So there's only a very small portion still remained. However, we do observe like there's pretty strong, pretty healthy occupier demand and strong office footfall at the Mandarin Gallery area. So this would sustain the retail rental reversion at around high single-digit level in FY25. And for capital management side, cost of borrowing has already peaked, and it decreased slightly by 0.1 percentage point this quarter. And we do expect OUEREIT to use its proceeds from the divestment of Lippo Plaza, which is around 330 million, to pay down its debt. So assuming like all the proceeds will be used to pay down debt, we'll be looking at 14 million interest saving, and this will translate into around 2% DPU improvement in the upcoming year. And the negative side is valuation for Mandarin Gallery and also Hilton Orchard saw decline of around 0.6% year-on-year and 2% year-on-year respectively. And the decrease is not due to cap rate expansion, but it's more like the outlook for hospitality and retail side is pretty muted for FY25, especially following a high base in FY24. But overall, portfolio valuation still improved by 0.2% year-on-year. And for the hospitality sector, RevPAR increased by around 9.2% year-on-year. But OUEREIT do expect RevPAR to stay muted in FY25 due to the lackluster event schedule in 2025 and also absence of the mega concert. And for outlook, top line for FY25 remain resilient, supported by the mid-single-digit rental reversion for both office and retail front. And for the hospitality side, it's a bit muted, but still, they will be supported by the continuous recovery of tourism arrival, especially when the tourism arrival for Singapore is still below pre-COVID level now. And OUEREIT successfully divested its only overseas asset, Lippo Plaza Shanghai, with price 5% below the latest valuation. So we do believe this has substantially de-risked the REIT, and also they have been transforming into a pure play Singapore with 100% of the asset generating from the AA rated Singapore asset. So we have lowered our FY25-26 DPU forecast by 10% and 10% respectively to account for the divestment of Lippo Plaza and also higher for longer interest rate. But we still reiterate our buy recommendation with unchanged DDM target price of $0.4 as we revise the cost of equity down to 7% post the de-risk of the portfolio. And OUE is trading at very attractive discount of 0.5 times price to NAV, which we believe is undervalued compared to other pure play Singapore REIT. FCT is trading at 0.93 times price to NAV, and Fires Hospitality Trust is trading at 0.65 times price to NAV. Yeah, moving on to the last country is Mapletree Industrial Trust. This is also Phillip on the crown. We don't cover Mint. The demand is still very strong. Mint achieved a positive rental reversion of around 9.8% for a Singapore portfolio. And the demand is still very strong for the ramp-up buildings, although occupancy dipped slightly. But vacant space is expected to backfill soon due to the pretty resilient demand. And the management expect this will take 6 to 9 months of the downtime to backfill the vacant space for the high-tech buildings. But the demand is expected to be supported by the semiconductor and also electronic sectors. And for the capital management front, gearing increased slightly to 39.8%, and average cost of debt decreased by 0.1 percentage point due to the lower financing, due to the lower floating base and additional JPY denominated debt. And management expect cost of debt to creep up slightly to around 3.2% in FY25. And for outlook, the management foresee positive rental reversion to moderate to around mid-single digit level over the next 6 to 9 months. And Mint is also adding acquisition of data centers, especially to in Japan side. Since they still provide a positive yield spread, and also funding in Japan is likely to reduce the all-in cost of borrowing. And their current exposure to Japan is around 6.6% for its AUM. And overall, we believe Mint, they'll continue to deliver very strong performance with DPU on track ahead of the expectation, and also with very stable interest rate profile. And it has a very diversified exposure across Singapore, US, and Japan to support its strategic pivot towards a fast-growing data center subsector. That's all for me. I'll hand over to Ding for technical pass.
Thanks, Mel. Morning, everyone. So, first up, looking at S&P 500, it was up 1.7 for the whole week. It formed a new all-time high last week as well on Thursday. So I think for this week, we could see more upside if it can hold above the 6,100 level. So for now, resistance is at 6,120 to 6,200 area, and support is at 6,015 to 6,075 area. Next slide. So next up for the Hang Seng Index, there has been a breakout of this descending wedge formation highlighted in blue. So the index was actually consolidating within this wedge since October of last year, and recently it broke out of this formation on last Monday. So I think there's potential for more upside here. Looking in terms of the price action, this came after it formed a double bottom at the 19,000 level, coupled with a bullish divergence on the MACD, which suggests a bullish momentum for possible reversal. And also, the price also held a throwback to the 19,600 level, which was a prior resistance, which is currently holding as support. So for now, resistance, it could hit towards the resistance area of 20,950 to about 21,620. And support is at 19,620 to 19,900 area. Next slide. So with that, we have a technical buy for the iShares Core Hang Seng Index ETF, code 3115, at $72.98. Take profit levels at $78 and $84.50. Stop loss at $70.60. Last close was $72.98. Next slide. Now, next one, we have a technical sell for Yangtze Shipbuilding, $2.93. Take profit levels $2.81, as well as $2.75. Stop loss at $3.01. Last close was $2.99. So this trade actually hit our stop loss. But the initial trade idea was that the price action actually broke down the pendulum formation in blue, coupled with a decreasing bullish momentum where the 5-day SMA actually crossed below the 10-day SMA. So that could be a sign of a slowing bullish momentum, coupled with the bearish crossover and decreasing momentum on the MACD. So next slide. Next one is a technical buy for Centurion at $1.02. Take profit levels at $1.11 and stop loss at 98 cents. Last close was $1 on Friday. So looking at Centurion, it has been consolidating in an ascending triangle formation since December of last year, with the key resistance at $1.01. So with the price breaking out above this level, and also positive price action signals such as price remaining above the 96 cents previous resistance level recently, higher lows along the way and increasing momentum at MACD, we see that the price we could see the price continue its primary bullish trend and reach a new high towards this take profit level, which actually confluent the height of the ascending triangle about 10 cents when we project it onto the breakout level at $1.01. Next slide. Next one, we have a technical sell for sets at $3.52, top take profit levels at $3.31, and $3.13, stop loss at $3.62. Last close was $3.44 on Friday. So looking at in terms of the chart, price has been actually just consolidating in a head and shoulders formation above the key neckline of $3.55 since September of last year. And recently we have seen some and since November, actually, we have seen some price weakness where it failed to hold about the $3.80 breakout level, which turned into a resistance subsequently in December of last year. And thereafter, price has been making lower highs along a downward resistance line. And just last week, we saw the price broke below this neckline support 355. So I think with that, we could see further pullback ahead to test these two take profit levels, which were previous horizontal price levels. Next slide. Next one, we have a technical buy stop for Nam Cheong at 45 cents. Take profit level at 49.5 cents. Stop loss at 43 cents. Last close was 43.5 cents. So looking in terms of the chart, yes, it's still kept in the range consolidation between 39 cents to 44.5 cents. But some positive price action signals is that with the increasing momentum at MACD recently remaining above the zero line, and also the 39 cents was previously a resistance back in December of last year. But price has been making a higher highs and higher lows recently, with this 39 cents currently acting as a support twice. So should the price break out this current resistance at 44.5 cents, we see that price could actually retest this 49.5 cents swing high level, which was formed in October last year. Next slide. So just to summarize all the trades initiated last week, for Yang Zijiang, he had a stop loss, so it is down 2.7%. Century is currently in progress, currently down about 2%. Sets is also in progress, up 2.2%. For Nam Cheong, the buy stop trade has not been triggered yet, as price has not reached above the 45 cents entry price. So that's all from my part. I'll hand over time to Paul to talk about the Singapore REIT. Thanks.
Yeah, thanks, Zane. Next slide. So I'll move on to just some macro news. Yeah, I don't know why last week Singapore had so much news. Anyway, let me just start. For Singapore, we had industrial production. So it's just a measure of manufacturing activity. It's still robust, supported by electronics. I think attending some briefings by some of the ports there is some front loading of ahead of Trump tariffs, but that isn't that much because the tariffs was uncertain. It's not like in 2018, 2019 where the tariffs were firm. So there was a bit of front loading, and also a slightly impact is the earlier Chinese New Year. But again, underlying manufacturing in Singapore is still healthy. We had some numbers on ready-mix concrete, so this will impact Pan United and also Hong Leong Asia because they are the biggest ready-mix concrete. Just a refresh, ready-mix concrete is basically the wet cement that you bring from the silos and you move into the construction sites. That's generally stable. I think you're looking about 4% growth. For the second half, you're looking at 7%, a bit slower than the first half, but again, 2025 should be an even stronger year. So the big news we had was from the BCA. So BCA, the Building Construction Authority, usually gives a outlook for what they think is the construction contracts to be awarded for the coming year. Usually accurate, because since so many scholars in there, I guess. So in 2025, they gave a range 47 to 53 billion. If you take the mid-range, you're looking at 50 billion. So this is a huge number because in the past they were guiding, if you look at the last end of you're looking at maybe 35 billion, but now they move it up to almost 50 billion. 2024 was 44. So this year you're looking at by mid-range at maybe 13% growth in contracts awarded. But if you take over the 2 years, you can see the big jump from 2023 to 2025 from 34 billion looking at 50 billion. So you're looking at about almost 20% growth year on year in terms of contracts awarded. Some of the contracts you're looking at is T5, MBS, Thomson East Coast Line, and Tuas Spot. BCA also gives a medium-term outlook. So they will normally give a rolling, they give a 5-year forecast. The immediate year is firm, and then the next 4 years is, so that was even more bullish. So they are looking at 42.5 billion, 2026 to 2029. But compared to their previous long-term forecast was 34 billion. So if you do the numbers, you're looking at 23% growth in terms of contracts. They upgraded their forecast by 23%. I think there was a typo in my morning note. I took 9%. But generally, it's a very bullish outlook given by the authorities, and they tend to be right. Yeah. Obviously. Move on to MES. So the MES made a change in their FX policies. They do it I think, should be every twice a year. There's generally no impact if you're an equity investor, because you're talking about maybe 1% to 2% kind of movement in their currency. But just for information purpose, the reason why they are, I guess, making the appreciation in Singapore is weaker is because core inflation is lower. Their forecast dropped from 1.5, 2.5 to 1 to 2%. And also the GDP is supposed to be slower in Singapore from 4% to 1 to 3%. So what they do, I'll show you the numbers later. I'll show you the chart later, but usually they will move the slope. So either but the default option for MES or the general option for them is to just increase the slope. That means always maintain a gradual appreciation of the Sing dollars against the basket of currencies. That means not against US dollar, against trading partners like China, Malaysia, all that. So they changed in October. They were maintaining the rate of appreciation. Now they just reduced slightly. That means it still appreciate, but I think at a slower pace. Yeah, it's all WAP in language they use. Anyway, we move on to some of the property price. We had HDB. It continues to be very strong. You're looking at 10%. This is the fastest growth in 2 years. And this will be a support from HDB owners moving into private. I wouldn't call it upgraders, but I'm just calling moving it to the private residential homes. So for residential price, it is still slow. It's about 4%, which is good, because if it's anything above 10% or double digit, then you always face the risk of cooling measures. But the quarter on quarter was quite a big bounce actually. It was a strong bounce from the third to fourth quarter, like 2%. Because prior quarters was negative actually. Had some data from the US, but generally still strong. I think the data we're getting from US, new orders, that means manufacturing activity actually bounced back up. The loans is also improving. So actually US is still trending well. Next slide. Move on to our usual tactical view. So having spent I don't know how many hours listening to Trump talking, interview, speech, and all that for the whole last 1 week, let me just give some conclusions. So the problem is going to have to keep doing this, but some of the conclusions is that for China, so he mentioned that he prefer not to use tariffs, and in general he's been very silent on China tariffs. It's only when asked then he mentioned tariffs. Otherwise he doesn't mention China tariffs on his speech or anything. So it's pretty silent. What we think, at least, or what we guess, is that there's probably working on a deal with TikTok. So he mentioned this deal with TikTok many times. And there's also a fentanyl deal, because if you know, China exports fentanyl, which is used in opioid, and Trump wants to ban it. So this TikTok deal is important, because if it really materializes, it could be joint ownership of TikTok between US and China, and this in a way could actually cement the relationship between China and US. So this is a very integral milestone if this happens. So this is something to watch, and if that really happens, then I think the geopolitics between China and US could actually take a notch down, since they both have ownership of such a major asset. But instead, the number two, the hostilities on their traditional allies was actually very strong. I think you can see he wants to impose tariffs on Canada, Mexico, take over Greenland, ask NATO to spend more on buy more. So he's been more hostile towards his allies. And actually, he says that North Korea is his friend. But okay, but anyway, so there's a change. At least he's not targeting Asia. The third thing is that he wants lower oil price. So he's erasing the amount of drilling happening in the US, and also he's asking OPEC to help bring low oil price. So as per our team, don't fight the Trump. So he wants lower energy price, and he will continue, and that should be one of the themes in 2025 and onwards. And I don't get the logic, but he mentioned that when the oil price is low, interest rate should also come down. I mean, I don't get the logic. I know the inflation rate, but I mean that's what he said. And for renewables, basically he called renewables a scam. So he says that. So what it means that there will be no approvals for wind farms, solar farms, and so forth. Because like I said, I think it's a scam. But anyway, and of course he's also pulling back the electric vehicle mandate. So that means the electric cars don't have to have such a tight emission standard. So you can still continue selling the normal gasoline cars, I guess. Domestically, it's the usual cut taxes, deregulation, investments. So anyway, having said all that, so what does it mean? So it means that it will still be generally very positive for equities. The bond markets actually took it as a sign that maybe inflation will not be as high as expected because the tariffs, that so-called 60% tariff on China didn't happen. But generally it's going to be positive on equities because he's very pro-growth, obviously. The other, I guess, less controversial view is that there could also be a peace dividend that could be positive for global equities. So what we mean by peace dividend is that before his arrival, there was already peace in Gaza. So in the Middle East, that in a way also affects the Suez Canal and also maybe even container rates. But what you see is also, if we do get a peace deal in Ukraine, I mean, then the narrative could change, that the geopolitics, the tensions is actually kind of taken a notch down or two. And of course, this is be positive for all of us as, I guess, global citizens, but it could be negative for gold. I mean, if geopolitics tune down, then maybe gold will be the weakness could come for gold, because it's always been an asset that benefits from geopolitical tensions. Moving back to Singapore, so it has been a massive upgrade in the forecast. So the forecast was from 34 billion to 50 billion. That was generally the forecast that the BCA is upgrading, 13% rise. And then the longer term forecast also, they notched it up to 42 billion, which are all record numbers for Singapore. So the way to play it for us is that, as mentioned in the past, we always prefer the service providers, because we think they always have better margins and the market share is strong. Like BRC's market share like 70, Pan United is 40. So that's why we prefer market share, building materials. And also worker dom is another area of service providers, because the demand, because for construction companies, although they should also benefit, but you're just not sure who to pick, and the margins are always very thin because it's always very competitive. So that's how we are playing it. For the events, these are the events to watch. A lot of events, a lot of the big, and also Samsung, just for your reference. There's also, of course, the FOMC meeting, but nobody talks about it these days because he's not going to move rates, and it's all about what he's going to say. And everybody's more interested about what Donald Trump says, because he will be the lead indicator, not the FOMC, because what he says could eventually cause the FOMC to react. So I think people are just less focused on what the FOMC says these days. These are all the events coming up, open for everyone. A lot of them are REITs, just for your reference. Next slide. Nothing much. This is just to show the uptrend in industrial production is still up, led by the red line, which is exports. This is RMC demand, which is generally, I think it's still steady, although it looks like trending down, but it's still steady growth. Next slide. Move on to contracts awarded. So for this, the blue line is the construction contracts awarded. You notice, the means they announced, that I'm going to award this company. So this year you're going to look at Terminal 5 and also the two integrated resorts. So that's why this blue line could actually hit another record at about 50 billion. So this is what the BCA is forecasting, the mid-range 50. So this blue line is going to surge. The red line, you can think of it is almost like revenue line. So the revenue would come in this year, last year, but also more into 2025, 2026. So you should expect strong earnings growth for the whole, either building materials and also construction companies. For this, they are forecasting, the future awards, there's a typo here, it's actually 23% to 42 billion. Because they gave a long range forecast and then they upgraded it. Yeah, sorry, this is I made an error here, it's 42 billion, 42.5. So actually it's a very aggressive jump in the long-term forecast by the BCA. Next slide. Okay, this is just for education, so just bear with it. Probably as an investor, you're not really that interested. Maybe if you have a REIT, if you own REITs, maybe there's a slight impact. But so this is how the MAS move around or play around or implement their foreign exchange. So it's usually when they announce, is usually the slope of the appreciation. So usually they will maintain appreciation. Then they actually, that means the slope of the appreciation is either, so now they're just reducing the slope the most recently January. When they're very aggressive, so you notice in April when they are very aggressive in strengthening the Singapore dollar was because inflation, as the post-pandemic, 2022, that's why the Federal Reserve raised rates. Inflation was very strong, so that's why they increased slightly the rate of appreciation. And you notice this thing here called the center. So this is like gapping up. They gap up the Singapore dollar. That means gap up like a stock market, your share price, they gap up. They rarely do this because it's very aggressive move, and that's when the inflation is very aggressive. The width, they hardly move. The width is normally when there's a bit of volatility, they are unsure. But I guess the MES is always very sure on themselves. So that's why they hardly do anything here, but it's usually the slope. Move on. So that's why we have this slope, width, and center. The width is hardly used actually. Next slide. So this is the most confusing chart that I ever do. But okay, so how to understand this is the blue. You see the blue bar here. The blue bar is when they do the recenter upwards. The usual, the gapping up. So when this happens, is when you notice the blue line actually surge up very strongly. So that's when they want to make the Sing dollar or the basket of currencies that they measure against very strong. Otherwise, most times it is increased slightly, and you notice they normally range between 1.5 to even 2%. So maybe reduce slightly, then you're talking of maybe 1% move. So it don't really move the needle if you're an investor. But the last point here is you notice the red line. So this is US dollar. When the line goes up, means the Sing dollar appreciates. So you notice that even though the blue line might be rising, doesn't mean the US dollar increase. So the basket of currencies is not measured against the US dollar. It's probably mainly against their trading nations like Malaysia, China. They don't give the weights, but if you look at the numbers, Singapore's trading with US isn't that much. We actually have a deficit with them. So it doesn't mean Sing dollar will appreciate against the US dollars. I just wanted to remind everyone, if you look at this chart, it's just mainly the basket of currencies, trading currencies. Next slide. Okay, this is very tiring. So let's move on to the last two slides. So this is a property sector. Of course, it's always going up until the TDSR in 2013. Not to go back in history, but the key thing to notice in the chart is this thing called pre-cooling rally. So what we see is that usually before the government imposed cooling measures, you notice it's normally up 9%. The last one was 10%, 10.6, then 11. So when a property price move up maybe 10% or 11, that's where you know there's going to be a red flag that the cooling measures will come, because it has always been the last 3 times they had was when property price. But right now, if you look at the latest one, it's 3.9%. So it means that there's no risk of cooling measures. Okay, so at least I mean that's the main purpose of this chart. But yeah, next slide. So move on to the HDB. So for HDB, this is a quarterly number. So it just shows that it's a really strong numbers coming up for HDB. You're talking about annual growth of about 8% for HDB resale, better than the stock market actually. The stock market about 4%. I mean not the last few years. I'm talking long term, but yes, after suffering from 2013 to 2019, then you can see there's been a very strong recovery in HDB prices, and this will support the private residential because the most of the buyers are actually those who sell HDB and then they moved into private residential. Okay, I knew this just for information, but I knew this all will be positive for real estate agents like Propnex. Okay, I think we can move on to Q&A. Yeah. I don't think there are more slides. Right? Next one. Yeah. Okay. Thanks, everyone.
Pick the sorry. Oil is FY overall DPU dropped it, and the fourth quarter DPU payout rose by more than 10%. Is OUEREIT buying now? We have a buy call for OUEREIT, and DPU increased in fourth quarter by more than 10%, was like essentially was due to their capital top up of 5 million post divestment of the 50% stake in OUEREIT Bayfront. And also there's like less capital retained. Last year they retained around 8 million, and this year it decreased to 5 million. And we like OUEREIT, essentially it's because of this very steep discount to its net asset value. It's trading at more than 50% discount. They have also been substantially de-risked post divestment of Liverpool Plaza Shanghai. So there's no more income risk from China for OUEREIT. And yeah, so therefore we believe valuation should be improved. And also DPO will be supported in the upcoming year from the pretty resilient rental reversion in Singapore. So for retail, we expect high single digit. For office, we expect mid single digit. Yeah, so this should support their revenue, and DPO should be supported by the decreasing financing cost. Yeah, so there's already a sign for OUEREIT that their cost of borrowing has been decreasing. And we do expect like they'll use some proceed, if not all the proceed, to pay down its debt. Yeah, so we are looking at 14 million interest saving, and this should improve DPU by around 2% in the upcoming year. Yeah, hope it answers your question. And the MLT keeps divesting non-China asset. Is this good when the problematic asset actually in China? How long more will DPU for MLT to dip before bottom out? Yeah, so we believe MLT is probably like having trouble divesting China asset since the liquidity in China remain tight. And also like banks is not willing to support the real estate related transaction. And management still see rental reversion for China to continue being negative, at least like for the remaining 2025. And there's also a large chunk of the list due to renew in China. So there's around like 23% of the portfolio by NLA due to renew this year. And then among those 20-ish percent, 50% of the list is from China side. Yeah, so they'll be renewed this year at high teens rental reversion rate. Yeah, a negative high teens rental reversion rate. Yeah, so this will drag down the overall performance of MLT. Yeah, so DPU is expected to continue to be dragged by China performance in 2025. And MIT is also carrying data center asset. Will it have the same performance as KDC moving forward? Especially now, MIT is starting to acquire data center asset out of USA. Yeah, so MIT, if I remember correctly, there's only around like 55-ish% of the AUM is for data center. And so the rental reversion won't be as high as KDC. So you won't be seeing like the 30%-ish level for MIT. But it's possible if they continue to acquire data center. But currently MIT's overall performance is dragging down by business parks. Since the occupancy is hovering at around 57% level. And also like occupancy rate dipped it for other sectors, like the high tech sector. And the only resilient subsector is probably the ramp up buildings, yeah, for MIT. Yeah, I hope it answers your question. After result, within 1 day of each other, MLT's unit price rose and MIT's unit price fall. MLT's outlook is discouraging, and the DPU dropped it badly, year on year, whereas MIT's qualities are overall better. Why is this so? Yeah, again, like mentioned, MLT's performance was dragged down by China's performance. Well, MIT doesn't really have a China exposure. Yeah, so and the overall performance for the industrial REIT, especially its outlook, is more positive. Yeah, so that's why MIT share price performance probably would be better. And FCT is, wait, let me clear this. FCT rating is accumulated by we have accumulated for FCT. Yeah, sorry, there's probably a typo or something. And OUEREIT MIT's forward dividend yield. So MIT is around 6 to 6.3%. And OUEREIT is around 6.3%. And MIT is probably around like 5.5%-ish level. Yeah, I'll hand over to the rest of my colleagues. Thank you.
Thanks, Mio. I'll take on some questions. For the first question, what is the outlook for US data center assets in the USA under Trump administration? Yeah. Recently Trump announced the Stargate project. So it is a 500 billion investment over the next 4 years to build AI infrastructure. So mainly there's a few companies which will collaborate in these huge investments. So initially it will be $100 billion investments, collaborated between OpenAI, SoftBank, Oracle, and also investments from Abu Dhabi AI investor. So I think this will be a tailwind for US data center assets, because having more investments in AI data center naturally means that the more money will be pumped in. But however, we do think that this 500 billion should be treated as a best case kind of scenario, because we don't know how much Trump will actually fulfill his words. So if we take this as a best case, and I think and maybe the worst case will be as status quo, like we should track based on currently how much the big tech companies are spending in their capex, and currently we still see an uptrend in terms of their capex spending, which is still a tailwind within these US data center assets. Yeah. Okay. There's a question. Paul, with Terminal 5 and MBS, etc., construction taking off this year, can your team cover companies who benefits from this activity? Has this company's price run up too high to enter? Yep. Thanks a lot for your suggestion. Because I will very soon compile a table of construction companies listed in Singapore, and I will break down their different stats and all. For right now, on the ground, from what I'm hearing, we still haven't found the companies which has directly won a contract with Terminal 5 and MBS, because most of the things we hear on the ground is that the main contractor for Terminal 5 is a Chinese contractor. So those contractors who directly won the T5 contracts are from China, who can manage to bid very low prices. So they are actually very competitive in this manner. So we still do think that the way to play construction, as what Paul mentioned, is through the building material sector, like Penn United and BRC Asia, because they will need the raw materials to build up these projects. Yeah. So once we do have a table of the breakdown of the different construction companies, we will update again. Yeah. Next question is, does China DeepSeek raise questions on hyperscalers capex spend on NVIDIA chips? How will this impact NVIDIA and Meta, which just announced 60 billion capex? Yeah. I think as you just mentioned, the big tech companies have been spending a lot on capex, and it is still in an uptrend in terms of their last 12 months capex spending. So we their CapEx spending is sort of like a leading indicator to Nvidia chips, and and for now Nvidia chips is still the best in the market, as what we can infer from the information sources we have. So right now we still do not know whether China's DeepSeek will um will actually make the big tech companies switch to open source models to train their AI models. But for now, we still do think that the capex spendings are are on the best AI GPU chips available in the market, which is Nvidia chips. Yeah. Okay, I think for now that's all from me. I can pass my time to my other colleagues. Thanks.
Thank you, Ikben. I'll take some of the US tech questions. So hi, Helena. Netflix will stop reporting paid subscribers and instead use a biannual engagement report. Can you explain more what this is about? Well, this is really because I think in terms of subscribers, they're already becoming really mature. Because if you compare with their closest competitor, Disney, their subscriber number is almost double the amount. So I guess they keep telling you the subscriber number, it already doesn't mean much. And the second reason is because, like I mentioned earlier, they're trying to explore into the new area, which is the ad-supported plan. So basically, they're giving a cheaper alternative for people who wish to pay less but don't mind actually watching the advertisement before they actually start watching the movie. So this aspect has been growing a lot, and they're trying to expand this business more and more. So this is sort of like their new revenue stream. So it's no longer just reliant purely on their subscription growth for revenue. Now they're looking more at increasing the CPM, how to drive monetization through advertisers. So now they're really just shifting their focus of engagement. So they want to kind of emphasize that they want to emphasize more on how much time users actually spend on their platform. So this shows people the value because they're trying to use that to monetize, like putting in more advertisement, driving CPM, all that. So instead of rather just focusing on the number of subscribers. So I guess for them, they think it's like a better measure for people now considering how they shift their business. So I hope that answers your question. Second one, any preview for the upcoming big tech results this week? So Apple's gonna release their earnings this week. Apple stock actually went down 15% in the past months because iPhone sales are down in China. It slipped 18.2% in the last quarter, and actually Apple has slided to the third spot in the China market, China mobile market, behind Huawei and Xiaomi. And also a reason TSMC, they also forecasted there's going to be a 6% decline in the iPhone chips. So definitely not a good look on Apple. Apple right now, their forward PE ratio is also very unjustified given all the declining sales and strong competition. And we don't see signs of upgrade cycle coming in already. So I would say right after the earnings, probably there's going to be an immediate stock price decline. But I believe the long-term prospects still remain strong with new product introduction and their AI coming in. So I guess that would make it a potential stock dip, which could be a buying opportunity, in my opinion. Yeah, so that's all from me. I guess I'll pass it to my colleagues.
Okay. Yeah. Thanks, Helena. Let's try and wrap up. Then can move on to technical. So Jaffa privatization offer at 62 cents. Is that a good offer given the IPO price was 80? Also, what will happen to Austrasia exchange with these shares was given FOC to Jaffa? Yeah. For me, any this Austrasia shares, the value, the market cap of this is traded in Hong Kong. I think that the market cap is only like 100+ million if I'm not mistaken. So it's pretty small, and I think Jaffa say a 50+%. So it's a very small part of the whole Jaffa group. That's number one. Will I take the offer? I think I would, because do remember. Okay, so firstly is that if the offer doesn't go through, I'm not sure whether the share price can of course sustain these levels. So there's always a risk when the offer is withdrawn. The second thing is, if you monitor Jaffa for many years, you know that this is a very volatile stock. It can from 20 cents go to 40 cents, 60 cents, one went to 90 cents, then can drop back to 20 cents because they're in a very cyclical business, which is a good thing. I mean, but just that they are in a way selling it at kind of peak pricing out of Indonesia in terms of chicken price and the whole environment in terms of peak earnings. So it's not like they are making the offer when earnings was collapsing. So to me, at least my own view is I don't have the valuations offhand, but it looks to be a compelling offer considering that this is a very volatile industry and he's almost offering at peak cycle rather. Of course, there could be more upside on because he's got the insight. Take privatizations are like insider information trading, like the insiders offering you an offer. So there obviously could be some upside, but judging from the history of this share price, I think that, it looks like a compelling offer because this is a highly volatile kind of stock. Hi Paul, do you see TikTok selling 50% stake? I'm really not sure, but because who knows, right? This is probably all the way to Xi Jinping answering this, but it's really a good signal. And Trump is really promoting TikTok. I think he's although they asked him about the risk, so-called data risk, but his comment was, "Who wants to take data on young kids and all that?" And China already has already selling so many products with that they can get access to data, be it chips or be it handphones and phones and so forth. So I hope it really goes through. Just think of it like I don't know, an offering to him or something like that, because then at least it would be a signal at least to the market that tensions are obviously coming down or like I said, taking a notch down. So I do not know the probability, but I really hope it really happens because it will really be benefit the whole Asian market here, especially Chinese stocks. Energy price govern everything, and energy price go down, inflation drops. Fed has room to drop interest rates. I think that happens on paper, but it's not just energy price because the CPI a lot to do also with shelter inflation. But of course, energy is one factor, but it's one factor maybe for goods sector, but for the services sector, there are more mechanics into inflation for services. There's also labor. If he pulls out so much immigration, then what will happen to unemployment there, the cost of labor in the US? So it is one lens, but it's not the only lens that drives inflation. But it's a valid point that of course energy is important. What led to micromechanics good set of results? So I think that probably two things. One thing was they did a major cost restructuring out of the US. So I think you can do the numbers, from 65 employees, they brought it down to 20. Although it's only 20, but each employee you could model in maybe like a 80,000 wage number. So a lot of it, we think the margin expansion was because they did some rationalization end of 23. So you're seeing it now. Second thing is there is some pickup in their front end, the wafer fab business. So I think these were the two things that helped drive their earnings this year, and the momentum should pick up. Because once I think what may have happened is that for their wafer fab equipment, where they have like 10, 12 customers, they did a lot of preliminary work. You call it NPI, like new products, but the customer didn't ramp. Because these are new products, it takes time for customer to ramp. Maybe these are products for new equipment that haven't been launched. So when you normally see a ramp like that or growth in wafer fab, the trend normally continues. It's not like the customer order 2 units then say, okay, no, I don't need anymore. So I think the momentum, the uptrend should be intact for them, especially they took out so much fixed cost, which is employee cost out of the US. Paul, do you still have a buy call on Thomson Medical? They are going to do a briefing, so we will update it. Yeah. So their profit warning they did was mainly out because of in Malaysia. So in Malaysia, there's a major restructuring in the hospital sector because insurance companies in Malaysia want to raise premium because medical claims has been rising. but the government actually clamping down on them, so said that they cannot raise premiums. The cap is 10%. So as a result, a lot of insurance companies are pulling out of hospitals, and I think maybe Thomson has been affected. You get a double whammy when you get hit. So if the insurance company pull out, of course you lose business. And secondly, then the existing insurers that you have might actually want more discount. And the third whammy you have is that when the business is low, the doctors will demand more, and then maybe you might have to subsidize the doctors and more. So once the insurance company pulls out, there's almost like a not double, it's a triple whammy to a hospital in Malaysia. So that might be happening, but I think these are starting to begin to recover. And but for Thomson, it's not only just operationally, which we always mention it will be rebound but not robust, but it's also because of the land they have in Johor. So that has a huge value there, and but it will take time because they will need to build a hospital, and then once they have hospital in place in Johor, then they can sell the excess land that they have surrounding the hospital. So that's basically the game plan, but that will take time. Will Trump ask government workers back to office, make private sector workers in the US back? Yeah, okay. So what happens is that if the government workers go back to office, then it will cost a lot of the legal services around, because a lot of the legal and all that also didn't go back to office because apart from being a tenant, of course the government will also wind down because there isn't much going to office. So there will be some snowballing effect, especially the places like Washington, because all the legal services, even retail are all down, F&B down because the government workers are not back. But there's something to note that it's not such a smooth sailing, although it's an emergency order by Trump. There is a trade union in the US. I've forgotten what it's called. There's the American American Federation of Government Employees. So they have a collective bargaining there where they can actually still work at home. It range from 5 days a week to maybe once a month. I don't know who's the lucky guy who got 5 days a week, but so this is going to be challenged in court because there is a collective bargain, there is a trade union agreement, and they're going to go through the legal motions whether can actually the emergency order actually enforce. So it's not so straightforward that all the workers suddenly tomorrow all will have to go back. So there's a lot of pushback. So I'm not sure where this will hit, but having said that, I think office you have to be very careful. So for office, it's almost location by location. So if you've gone to the US, one street might look very good, then you turn the next street could be you have homeless there. Don't ask me why. So it could be one street, the office building could be full, everybody like the building. Then 2 streets away, they could be homeless. So you almost have to analyze the office market in the US, office by office, block by block, to actually know what's happening. So it's not across the board the whole office market can recover. So it's something to watch. I mean, those who actually look at the office market deeply, that's what they say. So there's something to take note of. Hi Paul, good narrative on MES policy. The ringgit is a basket of currency. It's inside a basket of currencies. Why has the ringgit been strengthening so much versus the Sing dollar? Yeah. So ringgit strengthened not just the Sing dollar, but strengthened against. Yeah, I also go to JB to shop, but I also monitored that. So it's also against the US dollar. So what happened for Johor? There was a big re-rate. Sorry, for Malaysia, there was a big rating in the ringgit. Mainly because, of course, there was a lot of excitement over data center, a lot of excitement over SEZ, and the main one was that Malaysia was doing this major restructuring, which is very good for the country long term. So they remove a lot of the diesel subsidies, and you notice diesel, once they remove the subsidies, because that means the diesel were below market rate. So once they remove that, actually their demand for diesel dropped 30%. So some could say that almost 30% of this diesel was actually smuggled out. I do not know. I mean, that is one narrative. And they took but because this will impact the poor, they gave more directed subsidy to the poor. So this is a very good long-term story. The next one coming up is petrol. So if you go to petrol, I think should be, I think March or April. I don't have the exact date. So if you go Johor and get pump petrol, you always try to pump the cheap one. It won't be so cheap, which actually foreign cars are not allowed. But they're going to raise the petrol price too. But then subsidize the poor by direct subsidy. So this is a very good thing for Malaysia longer term. Paul noted Sentosa Colo family offer privatized 62 cents. What is the option for existing shareholders that held the there's really no option. I think sad to say that, of course, but there's really no option. You either accept or you don't accept. Then if you don't accept, if he doesn't get the 90%, so to compulsory acquire, I didn't go through the details, apologies, but the rule is that if he doesn't get 90% or more of the shares he does not own, then he might have to raise the offer to privatize it. And also, and of course, the IFA may also say that this is fair but not reasonable. Then he might have to offer a higher price too. So there's that option too. I mean, yeah. That there is a chance if maybe investors don't like the offer. Yeah. Any updates on the outlook for First REIT and Parkway REIT? Since very little news. First REIT, there was news. I think last week. I think Darren mentioned. I think for Darren, what was mentioned is that Ceylon, which is their major tenant, would want to buy back all the assets that they own. So this can be only a positive because First REIT is already paying I think 8 or 9% yield, and then if they buy back, then the REIT could actually the NTA could push back up to 29 cents or more, depending on the next round of valuations. So not sure if this will happen, but I think because it's private equity bank, they probably did the sums already, so they probably already given an offer, I think. But I think that's why there's a good news, because if it happens, at most you're just waiting around with a 8% yield in the near term. I think this one okay. I think do you think China government will pump prime can lift the Chinese economy this year and beyond? How much confidence? I don't think the Chinese government will preemptively support the economy. I think it's more like to backstop the economy. If it drops too much, then they'll come in. So I don't think they're going to stimulate, because they can't stimulate. They stimulate. They worry the debt or the borrowings in China. The debt will worsen. So they will just add more liquidity. So I don't think, based on what they've done, it's more of adding liquidity rather than pump prime. I think all of us just want them to throw money at the consumer, throw money at the property developer, but I don't think they're going to throw much money. They do it indirectly, maybe just lower interest rate, or give the local governments more money, and not rather than direct throwing of money at everyone's face, I guess. Yeah. What's the impact of sorry, let me just end this. What's the impact of high 10-year treasury bill now on gold? There's a lot of moving parts. So if interest rates are high, of course, then there's no definitive answer. That's why I'm stumbling on it. So the reason is because to move interest rates, it also means the global economy is very strong. So this could be actually positive for all the commodities. So that's why I hesitant to kind of talk about it. But the impact on gold is a bit clearer. I think if it raises rate, then of course it makes gold less attractive because of the interest rate burden. Yeah. That's the basic simplistic answer, but there's more to it, because it really depends on how people's view on gold. Because if they are very worried of inflation, it also means that treasury prices will come down, and people might want to get out of bonds and then park some money in gold. So there's a lot of moving parts. There's no direct link between treasuries and commodities. So that's why I'm very hesitant to say whether if treasury goes up, then immediately commodities will also go back up. Because it usually depends on why did the treasuries go up in the first place. If it's because of growth, then it actually could be good for commodities. So that's why apologize. I don't really have a direct answer for that. Yeah. Okay. What's your view on Ortec? So I think it's above or quite near our target price. So there could be two more news flow. Of course, there's a few more news flow. Will be the results. We think the results will be good. If the share price too high, maybe they might do a bonus issue. We're not sure. And then thirdly, there should be more contracts coming up. Hopefully, they can announce some SAF contract, which is one of their priorities that they are targeting. That they mentioned that renewable is an opportunity. So we think there's a few more news flow. At the very least, will be hopefully the results should be also good. Yeah. What's your view on Keppel? So I'm actually quite positive on Keppel. Mainly for two reasons. So of course, the immediate one is that if they can sell the rigs, so that's like 4 billion, at least from the notes receivable part. And the second thing is that in Singapore, the demand for electricity just surged up. So demand for electricity used to be 1-2%. Now the government is forecasting about 5%. So demand for electricity will be positive for them because they got a new power plant, the Keppel Cogen Sakra. So and demand for electricity in Singapore is good because of electric vehicles. Of course, government has a mandate for EV, and the second thing is that data centers. Because of that, the third reason is Keppel. Of course, they have a new power plant. They're also importing power. So we are importing power now. The testing is done on Laos. I know all the way from Laos, but anyway, the next one will be from Indonesia. So we're going to import power, and I think Keppel will also benefit because they got the imported power. So for me, they're riding on the whole wave of data centers, especially in Singapore, by being a power supplier and also a submarine cable supplier. And of course, they also have funds to build data centers. So they are also a big beneficiary in the whole data center. Having said that, don't expect the coming fourth quarter results to be strong because the 2023 they benefited a lot on selling land in China, so you're not going to get that. So the earnings won't be great, but I think the longer term is positive for Keppel. Okay, let me answer this last one and move on to, will the same effect affecting Thomson Medical affect Parkway Life REIT Malaysian assets? Because Parkway Life, no. I think Parkway Life is just getting a freebie from IHH because they related, right? So they because this is a tenancy, it's nothing to do with IHH. So it might affect IHH, but you're a landlord, so it doesn't. This is not like owning a hotel where you take a share of the revenue or profit. So there's no revenue sharing, or like in retail malls, you take a cut of sales. This one is just pay me. I mean, I'm a landlord. You don't pay me, I'll shut down the whole building. so it won't affect Parkway Life, yeah. But it might have some impact on IHH. Yep. Okay. I think I'll move on to my colleagues. Yeah. To take on. Yeah. Thanks, everyone.
Yeah, thanks, Paul. I'll move on to the TA questions. Yeah, okay, so I'll go through the Singapore and Hong Kong ones first, then I'll talk about the US ones afterwards. Yeah, so first one is sets. As shared just now, we have technical sell for set at 352. I think we are likely to see some more downside ahead. As price recently just broke down this support level at 355 with increased volume as well. So I think and looking at this previous candlestick over here, 21st August, there's price just surge up over here. So there's a volume imbalance. So I think the nearest support downwards will likely be around this 331 level over here. Yeah, there's also a price gap underneath it as well. So yeah, I think we are likely to still see some more price weakness for the time being. Then next question is on Yang Zhejiang Financial. Okay, so for Yang Zhejiang Financial, I think so for this, I think it's quite interesting because recently there's quite a lot of volume coming in, and also price just even though it's a first retest of this 44.5 cents resistance, price managed to hold above this area over here, and just today still trading above it, this resistance level. So I think there could still be more upside ahead as long as price remains above this 44.5 cents level. The next resistance, the next key resistance, I think will likely be closer to about 48 cents, which was a swing high back in June 2022. Yeah, so that's for Zhejiang Financial. Then for next one is for Bank of China. For Bank of China, I think it's also looking quite strong at the moment. Price, I think just these two trading days have managed to break above this trendline resistance it used to always pull back from. So I think breaking above the 395 level, I think we could still see some upside hit for the time being. Next resistance level, I think, will be closer to about 412 and then about $4.30 next. Okay, then there's a question: what's a good price to take out a position in Penn United? Yeah, so for Penn United, it just broke. It just broke above this resistance of the 7 with a very strong candlestick on last Monday. So I think for now, if it does a bit of a sideways consolidation, I think probably a good entry price would be closer to the 60 cents level. There was a deep swing low around 59.5 cents last week. So in terms of the short-term moving averages, we will pull that out. It's close to the 10-day moving average as well. So yeah, could maybe take out a position over there. Yeah, given the current strong upwards trend for now. Okay, then next question: is there any upside on StarHub, Zixing, and SIA? For StarHub, looking into the chart, I think for now I probably don't think there's much upside for now. It's still in this range consolidation for a very long time, since in May last year. So I think that will still likely continue, just mainly trading between about $1.17 to the top end of the range, about $1.26. So I think for now it's just currently in between around $1.21. So I think probably not too much happening in this counter right now. Yeah, then for Zixing, I think it's quite similar as well. Zixing, because they haven't break above this 0.031 resistance level, so it's just been consolidating sideways still. With support level, I think currently it's about 0.027, 0.028. So I think we just continue sideways until it managed to break above this resistance. I don't think there's too much upside for now still. Then for SIA, I think for SIA, I think there might be a little bit of a downside instead, and rather than upside for now, in my opinion. As price, you can see over here, this support level at 634 about here. Following this breakdown in terms of resistance, with the lower highs being formed. So currently, I think it looks like still in a bit of a pullback wave over here. I think we could see a slightly further pullback towards the next support level around 620. Yeah, so a little bit of price weakness currently for SIA. Okay, the next question is on IFAS. So I think for IFAS, it's currently doing a retest of this previous range consolidation level around like 737 to about 750 around here. So I would expect some resistance to still hold on over here, given that it's been consolidating around a month at this level. So I think price will move rather sideways at this level, 750, around 730 to 750 area for the time being. And then for the HST, which is the Line OCBC HST, I think this is quite similar to the iShares or Hang Seng Index ETF I shared on just now. So I think there could be still some upside here. Looking in terms of the recent price action, price broke above this downwards resistance line, first thing around 77 cents. Also, another thing is that looking at the recent price, since price recovered above this 74 cents level over here, managed to turn this resistance at 7 cents into a support. The next thing is that I think currently it just needs to clear this resistance around 81, 82 cents area. So the main is actually still in the range from about 71 cents to 81 cents. So if it managed to clear this 81 cents, I think we could see some upside towards close to this swing high, around 88, 89 cents level. Okay, the next question is on the Ascenders REIT. So for this, I think as with most of the REITs, it's just still moving sideways. So the range for Ascenders REIT is about 255 to 265. So I think it's still likely to continue in the range. But if there's a breakdown below this support, around 255, we could still see maybe some further downside towards the next support level closer to about 246. Yeah, given that it's in this downtrend over here and we haven't seen any signs of a reversal. For next one is CICT. Yeah, for CICT, I think also similar. We are seeing a range over here, 191 to 199. So for now, if likely to continue sideways, but if there's a breakdown below 191, we could see maybe some downside towards the next support level, which was this previous range support at around 185. I think maybe I'll just talk about the REIT index now as well. So this is the IHS REIT index. So looking at this, yeah, we can see it's just been moving sideways since November until now. It's about almost 3 months. So until for the index, I think for this it needs to break above 1028. Then we can maybe see some upside for REITs. If not, it's just likely gonna move sideways still. Okay, then what's the okay, then there's a question on HSBC. What's the target TA for HSBC? Yeah, so for HSBC, I think overall still very strong, quite similar to the Bank of China chart just now, where price managed to break over this trend line resistance $77 recently. Following this consolidation, still a very bullish trend continuation going on. I would think the next resistance level could come around here. There's a little bit of resistance from the past, from like around the $80 level, which also is a psychological level as well. Afterwards, I think will be maybe closer to $85 next for HSBC. These are based on like the previous levels seen in 2017, 2018. Okay, then there's a question on BRC Asia. Yeah, so for BRC, I think it's at all-time highs. Currently still very strong uptrend over here. So I would still expect that to actually continue for the time being. In terms of upside, maybe next level to look at maybe is the $3 mark. Yeah, since the rally started about 270 to about $3 a month, then maybe there might be a little bit of consolidation first, then maybe a bit of sideways first, then could move out more later. Then next question is there's a question on Semcorp Industries. So I think for Semcorp, the chart is still looking quite nice actually. So the key resistance to watch is still around 567 over here. But I feel that it's forming like an ascending triangle over here. We're seeing higher lows being formed. And so some positive is that some resistance over here at 530 is turning to support. And it's just been moving sideways since start of December. So I think if you can see a breakout of this around 567 level over here, I would expect more upside hit. But for now, still some consolidation. Yeah, above 567, next resistance level could be around 587. And the next up for Keppel is in a bit of a consolidation for now. The key support to watch is around 670. Just consolidating sideways, resistance at 690 to $7. So I think we'll just still do a bit of a sideways trading for now. Yeah, then below, if there's a breakdown below 670, then next support level you could test is around 655 to 660 level. Then there's a question on the STI as well. Yeah, for STI, I think we're seeing a little bit of a slowdown in terms of the bullish momentum. As overall, it's just starting to trade outside of this rising wedge formation over here, which actually we saw an acceleration in terms of the index going upwards. But recently, just been trading a bit sideways, but still, it's not a cause for concern yet. As still holding this level around 3,700. Yeah, just moving sideways. I think some resistance at 3,840, as well as the next one is around 3,890 about there. But I think we only need to be concerned if there's a breakdown below this recent consolidation support around 3,770. Then we could see maybe a little bit of downside towards like closer to 3,715. But for now, it's just moving sideways over here. Then there's a question on Bowstate. That's all about Bowstate. I think nothing too much. It's just still consolidating sideways between about $1 to $1.03. The key is to see whether it can break above this $1.03, $1.04 level. Then maybe you could see a bullish trend continuation upwards. Yeah, my guess, if it does happen, then it could reach maybe about $1.10 next. Yeah, based on the current rate height of the range, about 5 cents, and project at the breakout level. Okay, then I'll move on to some of the US stocks question. If you're interested in more US stock question, you can feel free to join. There's a TA session by me tonight at 8 to 9:15 p.m. Yeah, I'll talk more about US market. So for first question, GE Aerospace, I think this one on the results over here, we're seeing a little bit of a little bit of a resistance above 200 over here, where price just still can't close above this opening price since the top. So I think we could see a little bit of a pullback for now, towards I think this range of 190 to 194 over here. Maybe to perhaps to fill up this gap over here, then it could be fine support over here and rebound. Yeah, but overall still positive. I think because looking in terms of the chart before the results, it was just consolidating over here, and it broke out about the key resistance of 184 over here. So overall, I think we'll still likely find support around 190 over here. Then it could just rebound afterwards. And next one, Nvidia. Yeah, for Nvidia, it's still largely in a very big range bound pattern between like 128 to 152 over here. Recently it managed to go above the 140 level. But for now, I think probably there's likely to be a gap down today. So I think you can see if the 140 level here gives way over here, then I think we could see a little bit of a slight downwards pressure towards like 132, 133 next as a support. Yeah, but overall, as long as 128 still not broken, I think it's just doing a range consolidation. Okay, for AMD I think is slightly trading in this downwards channel over here, currently at resistance of 124. So I think we could likely see some gap down today to maybe then the price could retreat towards the recent support area of 117 over here again. Then it could just do a bit of a range consolidation over here. The next question is on Kava. So for Kava, I think it's likely to see some consolidation. Overall, I think the downtrend is still likely to hold since this mid-November over here. Price is just rebounding from this 110 level as it was a prior support level over here. Then still likely to face resistance from about 128, which was this prior horizontal level. Yeah, so I would expect price to just trade between 119, 128 for now, a bit of a consolidation. Given that it's like a double bottom here recently, then this 119 will likely flip into a support for the time being. And for next question is on Qualcomm. And for Qualcomm, overall it's also in a bit quite similar to Nvidia. It's just in a bit of a range. The big range is from 149 to 175. So this is still key resistance. So I think over here, above 175, we'll still likely to see some resistance. But some positive things recently is that this 164, 165 level supporting the resistance. But recently, last week, it broke above this resistance. So once it's likely to hold as a support. So 165, probably trading between this 165 to 175 area for the time. Also, just consolidation. Okay, there's a question on the three local banks. So first one, I'll touch on DBS. Yeah, DBS just moving sideways as we've seen just now doing as with the STI just now. So I think this $43 level still holding as support. Resistance for now is probably like 44 44 to 44.20 area. So I think we just move sideways for the time being. Yeah. Then for UOB, UOB is, I think it's just consolidating in this a bit of a wedge formation in blue over here. So generally between about 36.80 to about 37.80 range. So I think we just continues in this area for now. Then for OCBC, yeah, OCBC I think was currently still holding above this $16.90 level, which was a previous resistance support. So I think over here we have this trendline support coming in as well. That will likely hold the price. So 16, I think we likely still hold above this 1690 level. There's some resistance around 1730 for now. So just a bit of a sideways consolidation as well. Yeah. Then there's a question on CCB. CCB is Coastal Financial Corporation. So I think for this is probably at around the all-time high. Still a very strong uptrend recently. Looks like it's starting to do a bit of a consolidation. Yeah. So I think yeah, so I think you just need to watch whether it breaks above 87 again. Then with that, I think if it does, then I think the uptrend will likely continue. Yeah, given the overall prevailing primary bullish trend, then it's likely to be a bullish flag between 78 to 87. Yeah, the next target level I think could be closer to about 97 to 100 net degree. Okay, then I think I'll take the last TA question on Apple. Okay, for Apple, I think we're still seeing quite a bit of a price weakness. I think it's the weakest probably among the Max 7 for now. Still trading, still in a steady downwards trend along this downwards resistance line. In terms of price action last week, there was a gap down below this 229 level. And for now, like this resistance can come around 227 to 229 series. So I think we could still see some further downside. The next support level will probably be around 215, 216 about that, this level. Yeah. Then below that will likely be around 200, 210 about that. So I think for now still quite weak until the price can get above like 226. Okay, 229 about that. And this downwards resistance line as well. Yeah, so I think that's all for the TA questions from me now. I'll hand over time back to my colleagues if there are any more questions to answer. Thanks.
Thanks, Sin. I think just one last question about the DeepSeek question. Should we be worried in the long term with the advent of DeepSeek? I think for NVIDIA, we are now waiting for the Blackwell ramp. It is in full production, and this year we expect it to begin shipments. So this year for NVIDIA, we think that it will still be a good year. And as mentioned earlier, the big cap techs are still ramping up their capex, and we think that NVIDIA will be a strong beneficiary for this. As I think just my humble opinion, I think that with the advent of DeepSeek, we shouldn't be too worried in the long run because it's similar to when ChatGPT comes out. People were worried whether Google will be affected by ChatGPT coming out. So we do feel that NVIDIA, because it has a strong moat in terms of the many business segments, and as well as the Max 7, we don't think that it will. I mean, I personally don't think that you'll be it'll affect them so much. Yeah, thanks.
Yeah, maybe I'll just add on to that answer for the rest of the Max 7. So just for those who are unaware, DeepSeek is this China AI, OpenAI that has been it was just released recently. So there's a lot of big hype in the tech industry, mainly because I think it's like cents to the dollar for the number of processing that they can do. So basically, it's very cheap, and they only spend, I think, 56 million to build the whole model compared to the billions that the rest of the Mac 7 companies have been pumping in to AI. So it just shows how it can be done, cheaper and more efficiently, more effectively. Whereas the other companies are like requesting for billions and billions of dollars. Yeah. So I think the worry is that maybe the Mac 7 companies aren't are just trying to make as much money as possible, which I think they are also trying to make as much money as possible. But also that they are not doing it as good as they can, because if this Chinese company can come out and do it for like 50 million, why can't they do it too? But the tests have shown, I did try to read up a bit, but the tests have shown that it's, I think, maybe just as fast using older chips, right? So if they can do it, then why can't the rest do it? And also a big worry for Nvidia, because then their newest chip is not necessary. Yeah. So, but I feel they won't really have much of a hit to the Mac 7, mainly because firstly, security. This is a Chinese company. Right? Security is a big issue in the US, and globally as well. So you're not sure what they're doing with your data and everything. And especially nowadays, AI is even worse. And then secondly, also if you look at the Mac 7 companies, they do put in a lot of their AI. It's not this DeepSeek is not for the day-to-day person to use. Basically, it's really for people more into tech, into coding. Then they will go in and use this DeepSeek. It's not that easy to use, as compared to Google, or you talk about Facebook, Apple is all integrated into products that they're selling, or even Microsoft, right? It's like Copilot, WhatsApp AI, that kind of thing. Yeah, so I think that's the differentiator that the Mac 7 companies have, where they really integrate it into the programs and products that they have, not just give you this AI and expect you to use it yourself. Yeah, so I think overall they won't really be that affected, but maybe they just have to relook at how they are spending their money. Yeah, maybe then it could actually force some improvements also, because then they know that they have to do a better effort. Yeah, so I think that's all. Yeah, thanks. Maybe hand it back to Paul to close. Thanks.
Yeah. Thanks, Glenn. So with that, I'd like to thank everyone. So wish everyone 恭喜发财, have a happy Lunar New Year, and wish everyone a happy and prosperous and hot year of the snake. Thank you, everybody, and thanks for attending, and thank you for all your questions. And have a good week ahead, and happy holidays. Thank you.